I love to think in terms of movie metaphors, and one of my favorite metaphors comes from Interstellar. There's a bit at the end with Matthew McConaughey, and he's working with entities that can time travel, and they don't know what to do with that immense power. And they work with Matthew McConaughey's character because he has a relationship, he has an empathy for the person they're trying to contact and can, take their immense power and sort of channel it to something that actually drives change, that actually delivers a message. And I think there's an analog in that with AI, which is part of both the promise, but the peril of these AI tools, especially as the models continue to get smarter, is they can do just about anything. Software tools could do a very specific set of things and you could learn that. The challenge and opportunity with AI is because they can do everything, you need to be guided in how to actually use them to be useful to you.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to Run the Numbers. I've got an exciting one for you at the intersection of finance, operating a hypergrowth company, and investment banking. This episode is with none other than Rahul Rekhi, the president of Rogo. So if you haven't heard of Rogo, they are vertical software that is AI native for investment bankers and financial professionals. So if you've ever had to create one of these pitch decks as an investment banker, you know how tedious they can be. They take all the workflows that investment bankers go through to create their collateral and to evaluate deals, and they overlay an AI native platform so you can get it done a lot faster. This company is growing at a crazy rate, and he's the president there. So he's responsible for finance and much of their operations. We go deep on token economics. Yes, we talk about token maxing, and more importantly, ROI maxing. This guy knows his stuff in terms of what you need to measure across the different models you deploy when you are the seller passing through much of these AI costs. So if you're sitting there on your finance team saying, how do we actually gauge ROI on the tokens that we were spending? He makes it pretty clear for you. We also talk about this forward deployed banker model and how they look at repurposing the knowledge that many of these bankers have to both sell and deploy their software at scale, which is pretty neat. We talk about these go-to-market engineers. It's something that Clay made famous. We talk about forward deployed engineers across a lot of these large language model companies. So the way that products get into the hands of their end users is fundamentally changing. He talks about how Rogo is doing it. So if you're a go-to-market practitioner, this will also be very interesting for you. Let's get into it. Rahul, thank you so much for joining the show.
Thanks for having me, CJ. Excited to be here.
This isn't as great of an environment as the roof deck we met on when we did that panel for Tabs. I hope my virtual studio is accommodating.
That was a particularly special one, but this is special in its own way.
You're a renaissance man in many ways because you've been in banking, you've been in policy, been in investing, and now you're at the forefront of AI. I'm curious what pattern you saw that made you think that finance was going to be one of the first truly industries to verticalize AI? Because I think everyone saw customer support, but AI, I don't think that was at the forefront for a lot of people.
The first thing I'll say is I've lived it. And I was, as you said, an investment banker for many years. Saw firsthand, initially as a junior investment banker and then as someone with more seniority, the myriad frictions and inefficiencies that existed up and down the value chain in financial services. On the low end, you hear about all these stories about investment banking analysts and associates who are spending all-nighters producing PowerPoint presentations and Excel models, et cetera. And I, live that. But it's also true on the other end. If you look at, for example, all the corporate finance research on mergers and acquisitions, the consistent finding is that on average, an M&A deal destroys value for the acquirer. And so whether it's thought partnership or just basic deliverable creation, I've always seen finance as an area where there's so much room to improve the work product and how it's delivered. What's also true is finance is a sort of Goldilocks zone for applied AI. It's an industry where the marginal willingness to pay for intelligence, for inference is high, but it's also deeply regulated and, enmeshed with domain-specific technology from often decades prior, business practices, habits, culture that requires wholesale transformation. And therefore, it's a great sandbox to bring AI into workforce evolution and reinvention. So both of those forces, I think, got me really excited about bringing AI to finance.
You mentioned pulling all-nighters and that being a feature, not a bug of investment banking. I did consulting, not investment banking out of school. And I would ask my friends who like were doing iBanking, like, why don't they just hire more people if that's the problem? And you can correct me if I'm wrong. It's like you need somebody to know everything about that company and be fully enmeshed in the deal. Like their life is understanding that one thing and being Johnny on the spot for any stat that you need.
Yeah, I think that's right. Let's say you're working on an IPO, for example, or an M&A deal. You have to pull together so many different threads. You need to know, for example, what the management team and board are focused on narratively or quantitatively. You need to know a lot about the investor universe or the counterparty universe that matters for a deal. You have to know the history of all the decisions that were made along the way in, putting together an S1 filing, for example, and somehow retain all of that context. And it's very difficult even for, new joiners to deal teams, as does happen, to absorb all that context partway through a transaction so that you can be effective in a deal and continue to maintain that context throughout, weeks or months of a transaction being executed. So that's both the challenge in this space, but also the opportunity that with AI agents you can start to tackle as you codify more of that context into data and processes and knowledge that agents can leverage.
So we're going to get into the problem that you're solving and we're going to go deep on Rogo, but your title is president, which is one of those titles that it's super cool. It can mean so many things though. It can mean internal operator. It can mean external evangelist. What does that look like in practice for you?
It is a little bit of both. One thing I observed when I joined Rogo about a year ago is the surface area for vertical AI companies, as distinct from vertical SaaS companies, for example, is so much wider. A company like Rogo is simultaneously building the core enterprise software motion, deploying white glove enablement with folks from the industry, forward deployed bankers, forward deployed engineers, of course, everyone's familiar with, content partnerships that are not dissimilar from what life was like at places like Netflix, negotiating content deals with the streaming studios at the nascency of the streaming business, also an AI lab. And somehow you have to make all of these motions work in tandem to achieve what we want to achieve. And again, for our brethren in applied AI and other industries and verticals, the same is true. So in part, the complexity of the business means you have to really think about having a senior team that has the connective tissue across these functions and can flex in and out of different needs of the company. In a similar vein to the complexity of managing context in a deal, manage that context within Rogo. Part of the job description, as it were, really for any of us, is to be intellectually nimble and understand how these pieces fit together so as to, knock down what's important for the business, whether it's growth or partnerships or opening up new offices, et cetera, et cetera. The other piece that's unique is, for someone like me, typically when I would join a company, I would lead operational functions like finance, BD, partnerships. Given my background, that's the obvious operator market fit, as it were. What's also true is so much of what we're doing is, transforming the work of the financial professionals in the industry at both an individual level and a firm level. And, someone who can, like myself, speak to that, especially from the senior banker vantage point, has a unique voice as an evangelist with clients and stakeholders and in thinking about direction and product strategy and roadmap, et cetera, as well. So it creates this environment where the traditional boundaries of what's in a job description blur, just as the boundaries between business models are blurring as well.
You brought up vertical software. I have a president in my mind at a large auto tech company, and his whole remit as president was internal facing. It was basically everything within the go-to-market organization, including the CRO, including the CMO. And his day wasn't really external. But I think of another president at a cybersecurity company. This person is almost all external facing. It's kind of like IR and corp dev supercharged. So it's an important position, but hard to describe in one sentence, depending on the context in which you're functioning in.
One piece of advice someone gave me, and I have mixed feelings about whether this advice is true, but it certainly applies here, is in some ways, if someone can describe your job or your portfolio in a single sentence, you're probably leaving value on the table. The more useful or indispensable you are to an organization or to a mission, there's going to be more complexity in how people describe what you do.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Hey, founders and finance folks. You know how early on everything is fast and scrappy, and then suddenly equity gets messy? Spreadsheets break, grant docs pile up, lawyers are sending new forms and collecting fees. It all shows up right about when you're already swamped. Well, if managing your cap table feels like one more frustrating thing on a very long to-do list, you need to know about Pulley. Pulley makes equity management simple and stress-free. You can issue options, model dilution, complete 409As, and more. All in one place with support from real experts when you need it. So if you're raising, hiring, or scaling, Pulley keeps your cap table clean so you can stay focused on building, not wrangling spreadsheets. Learn more, request a demo at pulley.com/mostlymetrics. That is PULLEY.com/mostlymetrics. I got news for you. The ERP category is finally getting disrupted. And if you haven't heard of Rillet yet, please pay attention. It's the AI native ERP built specifically to replace NetSuite, and it's already won over hundreds of finance teams. Their mission is to make the zero-day close a reality, and they're actually doing it. We're talking teams closing the books at 1:35 p.m. on the first day of the month. Companies like Windsurf, Mercor, and hundreds of others run their entire finance stack on Rillet. Revenue recognition, close management, multi-entity, native Stripe and Salesforce integrations. Woo! Everything a scaling company needs. They've got 5.0 stars on G2. They're backed by A16Z and Sequoia, heard of them, and CPA-led implementations that get you live in 45 days. That is simply unheard of in the ERP space. If your books aren't running as fast as your business, check out Rillet. Book a demo at rillet.com/CJ. That is RILLET.com/CJ. That's me. Everyone in finance is adopting AI right now. There's a problem because there are a dozen disconnected tools. You got one for revenue, one for AP, one for close, and each one of these needs training and documentation. And the expertise to run them lives in your team's heads, not your systems. Maximor takes the opposite approach. One autonomous finance platform for the whole operation. Order to cash, procure to pay, the close, cash management, reporting, running on a single unified finance context that pulls from your ERP, billing, banks, even email and Slack. Maximor runs on self-learning agents that learn how your team already works. No prompts to write, no workflows to build, nothing to document. Every output is audit ready, and when a call needs human judgment, it escalates for review. Because the agents optimize, not just execute. And your KPIs improve. I'm talking about DSO, working capital, cash conversion. In fact, one PE-backed customer cut their close in half. Their audit findings from 7 to 0, back office costs down 70%. And in 6 months, no ERP rip and replace. You pay only for real outcomes, not seats. See it at maximor.ai. That is MAXIMOR.ai. Well, we have a ton of CFOs and investment bankers who listen to the show, and many have not encountered Rogo yet or partnered with an investment banker who's using Rogo. What problem are you solving that Excel analysts and generic AI co-pilots that are getting thrown at us can't solve?
The North Star for me and the company is about how can we change the way financial transactions happen? In a lot of ways, the individual productivity tools, to your point, having an AI agent that can build an Excel model or a deck or a memo are just a wedge or a stepping stone to, if you look at an M&A or a financing, how do we take this incredibly complex process that embroils CFOs and their teams and boards for weeks and months, involves lots of different consultants and advisors. How do we make that so much more efficient? And in the same way that 30, 40 years ago, just to trade a stock involved a chain of human beings, the stockbroker pitching the client, the person on the floor of the New York Stock Exchange yelling the trade to someone else to hear that trade. We've gone from that to you and I can trade a stock on Robinhood, in our pajamas for free. There's going to be a similar evolution and transformation in financial markets for these types of transactions that today are very analog. And so when I think about the problems that we're solving for CFOs, it's who are participants in this transaction ecosystem. It's to open up over time liquidity and markets in transactions that are AI first and agent first, and therefore make them much more digital and not just analog, and make them much more efficient. That's what we're building towards. And a lot of the pieces we're putting in place for that end state are about the infrastructure of a deal, agentic data room and agent-to-agent communication in transactions, the firm-wide institutional intelligence, so that the agents can capture the context, as we were talking about earlier, that's relevant for a transaction or a deal. So that's how we approach ourselves, and that's the set of problems we're going after. Very different from co-pilots and chatbots and so forth.
Just reflecting back, I love how you put the transaction at the center of this. That's what you're solving for. It's not, this is just software for this one ICP, this one persona. Like, yes, you have to do that in order to sell whatever you have off the back of the wagon, per se. What you're trying to do is solve for an overarching problem that sits between these two parties. And it reminds me a lot of how we've seen a lot of the large transactions in our lives. Like, you can even buy a house online now. Like, we thought buying a car online years ago was nuts. But what you're doing is fundamentally solving this way that people transact.
Yeah, that's exactly right. It's thinking about how can we make financial markets, capital markets work better for businesses and the leaders within them, like CFOs, households, families, investors who are ultimately on the financing side of every transaction, and even governments, regulators and governments participating in capital markets as borrowers or as investors, and make the whole system more efficient for everyone.
We hit it off real quickly because we found out that we're pretty passionate about token economics and AI business models. And I was just asking you questions left and right. I heard you say that token maxing is not transformation, which is awesome. It feels like one of those phrases that will age pretty well. What are companies just misunderstanding right now?
There's so much focus on adoption. People are underestimating just how useful these models have become, are becoming, and therefore, as usage trends up and to the right, what that means for their P&Ls. We've crossed an event horizon in the last 4 or 5 months, in my view, where AI has gone from being about workstations or terminals, someone sits at the desktop, does some research on a chatbot, to essentially an agentic workforce, even if people don't typically think of it that way yet. And an agentic workforce, in the same way that people's workforce or headcount today is typically one of, if not the largest P&L driver across a range of functions, an agentic workforce will also be, a major P&L line item in the form of token expenses or inference costs. And so thinking a few steps ahead, a major problem that basically every business of size is going to encounter is how do you make sure that token spend, that inference spend is allocated well and allocated in a way that drives the business priorities in the same way that businesses think hard today in strategic planning about how headcount is allocated. That, I think, is missing from the conversation, what will become quite obvious in the coming weeks and months.
I'm a CFO, and what I've found disheartening, off-putting about a lot of the conversations that are going on, it's around activity and consumption. There's not a ton of talk about ROI. How do you think we ended up here?
It's easy to measure adoption. It's very hard to measure ROI. They require new frameworks that are domain specific. The notion that one, for example, can look at queries per user is a horizontal concept, right? Any organization can look at the number of queries that their employees are leveraging on average with an AI tool. It's so much more challenging to then go a step further and say, okay, is this token spend aligned to, for example, in an investment bank, winning clients, completing deals more quickly, providing differentiated advice? It's just hard. And not only is it challenging because it requires bespoke work, it also is challenging because it requires that kind of embeddedness and connectivity with internal systems. And not thinking of AI tools as something that lives out here, disconnected from the business, but as something that's central. I mean, even just the concept of ROI in an investment bank, for example, you have to know how a deliverable connects up to a CRM, whether it's a Salesforce or a Deal Cloud or similar, so that you can tie the client interaction to an outcome. You have to have it feed into whatever your ERP is, whether that's a spreadsheet or a proper system, to know what that means in terms of, fees and how that affects, the revenue trajectory of a product line or a business line. And it has to tie to performance management systems. So all of that, is cross-functional in nature and much more about enterprise transformation than it is about just AI procurement adoption. So I think it's going from AI 101 to 301, 501, PhD level AI adoption. And that's the journey that we're on.
Hey, thanks for listening. We'll be right back after a word from our sponsors.
The CFO role has evolved faster than the tools built to support it. Most finance teams are still running infrastructure designed for a job that no longer exists. the reporting, the reconciling, the close that bleeds into the next month or quarter. That's not finance, that's overhead with a really crappy title. And the cost isn't just your time, it's everything your best people aren't doing while they're buried in it. Agentic finance shouldn't multiply your output, it should eliminate the work that was never worth doing in the first place. And that's why I run mostly media on Brex, an intelligent finance platform with AI-powered agents that capture expenses automatically, enforce policy before the spend happens, and close your books in minutes instead of weeks. 35,000 companies like OpenAI, Coinbase, Anthropic, and DoorDash already run on Brex. It's time to get Brex AF. Learn more at brex.com/metrics. Today's episode is brought to you by Anrok, the sales tax platform behind companies like Anthropic, Notion, and Vanta. Here's a fun way to totally ruin a Tuesday. Open a letter from a state you've never set foot in, telling you that you owe back taxes you didn't know existed. Happened to me, because the rules never stop moving. States are now racing to tax AI, digital ads, streaming, really anything new, and they're doing it faster than a spreadsheet can keep up. Anrok handles all of it. One platform that watches your exposure everywhere, automates compliance, and flags risk before it turns into that nasty gram. That's why thousands of finance leaders trust Anrok to stay ahead. Talk to an Anrok sales tax expert for a personalized exposure estimate at anrok.com/RTN. That is ANROK.com/RTN. Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. RightRev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. RightRev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com. I think there's a lot in common with what you said with if you look at the CFO tech stack and how expenses are expenses to a lot of companies. Like you could be running, I don't know, like a dry cleaning business and you have a rent expense. You could be running, I'm sure your company has an office. You're an AI native software company. You also have rent expense. How you measure revenue and how you get to $1 of revenue is so linked to what your product is. And that's harder to do with ROI. And it's going to be different for every single company.
And even different within companies. I mean, again, I'll talk about the context I know best. You take the work of a large financial firm, you have investment bankers that are serving clients, you have sales and traders that are selling institutional securities or trading on behalf of the firm. You have wealth managers that are out there, meeting with family offices and retail clients, et cetera. And those are all pretty distinct business models. So really going business unit by business unit, mapping that, as you say, is going to be a process of, months and years. But I think it's going to separate the organizations that and the CFOs within those, the finance function leaders that really know how to deploy these tools in a way that's value created for the business. And by the way, I think the difference between organizations that spend tokens well and ones that don't will be for the largest businesses, on the order of magnitude of hundreds of millions of dollars and maybe even more than that as usage goes up into the right.
And I think we're going to have to budget for it very differently than how we budget for it today. Right now, a lot of it's just in this experiment budget, but how do you translate that to a labor budget? And then how do you budget for it on top of the existing labor you have? Is it going to be something like it's an uplift similar to how we think about healthcare? Hey, if you're in the US, it's about a 20% increase from whatever the base comp is. Are we going to be budgeting for tokens where it's this person makes $100K a year? We also assume for the engineering department, uplift by 30% for their token allowance.
To, even understand the business models of participants in the AI ecosystem. So much of the AI industry has a profit model tied directly to token maxing and has a direct financial interest in making sure that users are hitting the most expensive models for tasks that don't require them or for tasks that aren't necessarily value creative for the business. And so part of the other challenge here is so much of the market not really being incentivized right now to actually manage those token expenses. Part of what I expect to see more of, including from companies like Rogo, is that kind of model broker function where, for example, if you look at our business model, we're not making any margin off the token spend that we're delivering or procuring on behalf of the financial firms we serve. We set that up very clearly so that there is an alignment of interests with ROI and transformation as opposed to, just shipping tokens. And also that orchestrator layer that's neutral as to the provenance of the tokens, i.e. making sure that firms understand the kind of performance cost frontier and can frankly just arbitrage which token supplier, whether it's an open source model or a frontier lab or a new entrant in the space, that you're getting the highest utility or highest value token and not just highest volume of tokens.
It's so important to think about what the incentives are of whatever company you're dealing with. I mean, it also applies like if you're selling into a company, you want to know your customer's P&L and how they measure success. But even just as a user, as a consumer of these large language models, I had a friend the other day who said, I think I'm going to use Claude more now because OpenAI, it's been giving me the runaround when I ask it questions. It won't give me the answer I need. I feel like I have to ask it 3 times to finally get to the point. And then he's like, I think it's because it wants me to burn through my allowance, so I'm using all the tokens.
The opportunity here is to leverage agents in a way that's deeply P&L specific. There's a real outcomes-based pricing or commercial model tied to usage of that inference. And I'm not saying we're there yet, but I think we're going to end up there. And I think in a lot of ways, the financial industry is a natural bellwether for that. I mean, every investment banker that a CFO engages is paid on an outcome, paid on a deal happening, paid on an IPO, and not only the actual transaction execution of the IPO, but the spread of the price offered to the market and the price the company thought they'd be getting going into the process. The sell side analysts that a CFO or his or her investor relations team might interact with have an outcomes based component to what they deliver. They have to get the votes of the hedge fund portfolio managers that consume their research. So all that's simply to say that the entire architecture of the industry is built around outcomes. And so we just need to adapt that outcomes based model to token spend, to AI spend. And so we're very focused on that. And I think I'm excited about the prospect of that in the coming months.
It's an interesting point that AI pricing and investment banking fees aren't that different or don't have to be, because bankers are really the highest paid outcome-based pricing business that I can think of. Like before, I thought it was maybe real estate agents. I guess you could sell a really big house, but bankers get paid only if the deal goes through, right? So it does make me think that if we can get our cost structures nailed down, outcome-based pricing makes a ton of sense.
And this isn't just academic. There are some real examples that, I'm seeing and that naturally lend themselves in an industry like financial services, for example. There are, so many businesses today that investment bankers can't or won't cover. If I return to my roots as a managing director at Lazard and I spend time with a business that has an enterprise value of, say, less than a few $100 million, that was a pretty quick way to get fired. In part because that was not a business that I could serve on Lazard's cost structure in a way that generated a return for the firm. With agents, there are many, many more businesses that one can serve in a way that's still economical and that, effectively expands and democratizes access. You can easily imagine models where we and other agentic orchestrators take revenue share on those markets, on those transactions that are opened up in an AI-first operating model. And that would be directly aligned to outcomes.
You make a good point about history, the history of the financial services industry in particular. If you think back even like Square, the unlock there was that it allowed some guy like outside of the garden selling t-shirts who's only making $35,000 a year selling t-shirts to accept credit cards for the first time. That was like a completely untouched frontier below a certain amount because it doesn't make sense for the credit card companies. Same thing for like a Robinhood. You couldn't have people trading 1 or 2 shares because it didn't make economic sense. So I think what you're saying is like, this is the next frontier to have that unlock. And it's probably below what you would call the middle market. But I totally get what you mean. Like for some banks, they can't afford to get out of bed in the morning for deals under a certain size.
That's right. And a lot of the transaction execution, judgment, knowledge, market intelligence are on Wall Street today is at the end of the day structurally gate kept within a relatively small set of institutions. And to your point, CJ, with a pretty high admission price, pretty high membership price. There are so many businesses and institutions all around the world that aren't yet members of that club, but could be as the prices come down. I mean, I'll give you an anecdote on this. As you mentioned earlier, I used to serve at the US Treasury. A big part of where I had spent time in international finance was in part working with emerging market economies, enabling them to have capital markets access so they could invest in climate and growth and development in private markets. Governments aren't typically getting lots of attention from the major investment banks on how to navigate a bond offering, how to, for example, get a credit rating that sets them up for success. And so there are nonprofits, including ones funded by the US government at the time, that were willing to offer some of those services on a pro bono basis. Now, imagine making AI agents who are trained to do this sort of financial work, available at de minimis cost relative to, traditional financial fees to these governments, and have an AI first investment banking advice and underwriting product that enables them to have the expertise they need to navigate the bond markets and, again, kind of lower cost of capital for their countries. There are so many of these spillover effects that we're probably not even contemplating right now.
There's this charity that I'm passionate about. It's called Charity Water. They build wells all over Africa and third world countries. And the founder of it was saying, like, it's a really hard pitch for me to try to get extremely smart people to come and work here. You are not going to be rich working here, but it's like a great cause. If you think about AI, you're unlocking that expertise, like you said, giving banking advice to some of these countries that they wouldn't have been able to access otherwise.
It's a major part of what drives me and drives others at Rogo as well. That notion of, really democratizing access and accelerating economic progress that way.
I want to talk about the unit economics of tokens again. Sometimes I'm like a dog with a bone here. I've heard you say that not all token spend is equal. What do you mean by that?
I saw something on social media, and it's an expression that stuck with me, which is borrowed from that old quote about marketing. You know that 50% of token spend is useless. You just don't know which 50%. In our user base, and there are 35,000 or so bankers, investors on the platform, you see people driving token spend, inference spend on research tasks where they're leveraging the most advanced flagship models, the GPT 5.5s, for tasks that could be done by models that can perform the exact same task at lower latency at a fraction of the cost, 3x cheaper, 5x cheaper, even 10, 20x cheaper. And only because for the user, how can any one user keep up with the proliferation of models available to them? And frankly, why is any individual user incentivized to go for the less expensive model versus the most expensive model? What we find pretty consistently is users will default to the most expensive models, the max reasonings, the most token budgets the AI system enables for them. Partly it's that routing question of, can you take a task and have the task be performed equally well or better, and certainly faster by a much less expensive model? And then that dollar of token spend on that research task using the most advanced frontier model is actually so much less efficient, so much less valuable than the 25 cents or the 10 cents to perform that exact same task using a cheaper model. What's also true is the context around these AI agents really matters. If you're a CFO or you're an investment banker, you've surfaced the right context for those agents. If you have, for example, agents that are connected to your financial data, as opposed to, just leveraging MCP servers or scraping the web or scraping an SEC filing to get the same financial data, you can do it so much more efficiently with a direct connector, because the amount of tokens that agent needs to spend to actually arrive at the right data, the amount of loops it needs to go through before it finds the PE multiple that you're focused on or the revenue growth figure you're focused on, is so much less. And it's a little bit like the difference between using a fuel efficient car and a gas guzzling SUV. Both will get you where you need to go, but you don't need that SUV every single time. And so having that, set of context surfacers, those data connectors that matter to a workflow, might be connectivity to S&P or FactSet for an investment banker or investor relations analyst or what have you, makes a pretty big difference in the token efficiency of the workflow as well.
So, personal anecdote. This week I was researching how net dollar retention rates and the disclosures along with them have changed for 80 companies over the last 5 years. And so I threw the latest model of Claude at it, and it had to go back to 80 times 4 quarters. It had to go through a lot of these. This is the first time I've ever ran out of tokens on my personal Claude Max plan. I was on the $100 a month. I had to upgrade to the $200 a month to fix this. And then it got me to think, like, me as a small business owner here running this media and research and recruiting company, I had no idea which model I should have been using. I just wanted it done right and I wanted it done fast, but I ended up having to pay more. And you brought up this interesting notion of a broker or someone that sits in the middle. Where do you see that going? Because on one hand, nobody wants yesterday's newspaper, but on the other hand, I don't know which model to use if I do want to save money.
I think that role of a model broker is going to be so critical in how AI is deployed in knowledge work in general and in finance in particular. And that is the notion of this trusted intermediary between the suppliers of intelligence, the model companies, open source AI companies, and others that are in effect utilities for the entire knowledge economy, and the end users, the firms, the businesses that leverage that intelligence for work. In part because those brokers, to your point, have real-time workflow-specific data on how to tie a specific model to a specific output. Even when I look at just our own evaluations of financial work, we see that performance cost frontier for different models, for different kinds of financial work, as being very uneven, very jagged. The exact same work product can be produced at times with models 3 times cheaper or 5 times cheaper than with another model. Routing those user queries, as you say, CJ, to the appropriate model for the task at a point in time and then over time becomes really valuable, and I think can drive enormous savings, again, for the largest businesses in the hundreds of millions of dollars. That's going to be a core function, particularly as the complexity of model procurement grows. In lots of ways, the analogy I've been using in other contexts is in the same way that for an airline, for a carrier, being very strategic about how fuel costs are hedged, forecasted, managed, the same thing will be true for knowledge work as it relates to tokens. Brokers are going to be a key part of doing that industry by industry.
It's a brave new world. If you think about the brokers, that's one component of it, right? They help you get the best pricing. But within the org, who do you think owns AI efficiency? Is it going to be engineering? Is it going to be finance? Is it going to be procurement? Is it going to be operations? Is it a department that doesn't exist yet?
I think businesses are trying to figure that out. But if I had to guess, I would guess the finance leader, the CFO, ultimately is at the center of that. In part because at the end of the day, everything's got to fit into a P&L. Anything that a business is underwriting around efficiency, whether it's in cost or revenue growth, has to map to a model. And finance has always been the backbone of accountability and numerical legibility in a business. And I don't see that as being different in AI. Finance leaders are also inherently cross-functional. AI efficiency is at its very core an incredibly cross-functional exercise for any business. And so the finance leaders are best positioned, I think, to integrate engineering, procurement, operations, all of the other components that go into figuring out how efficiency is mapped onto an enterprise.
When you think about mapping that efficiency onto an enterprise, it makes me wonder if in the long term, we're headed towards a world where companies stop caring about the model underneath. It's just the utility, like pipe the water into my house, and only care about the economic outcomes.
C-suites, CFOs, boards are accountable to KPIs and OKRs, not to token spend. I'm observing 2 trends that I think reinforce that prediction, which I completely agree with CJ. One is the catch up from the open source model community. So open source, open weights models, much cheaper, much less differentiated when it comes to model performance. They're pretty consistently 4 to 6 months behind where the frontier labs are. And there's some reason to think that that might narrow. There's some reasons to think that might widen, but that seems to be a great base case. Therefore, by the end of the year, we're going to have open source models that are 10x or 100x cheaper, but deliver the same performance that people are getting out of, say, GPT 5.5 or Opus 4.8 or Gemini 3.5 or 3 today. What that means is, to your point, that intelligence layer, that base layer, becomes a reasonably commoditized utility, number one. And then number two, the actual intelligence saturates. One way I orient myself with clients and the value add that we're providing is, imagine if you and I showed up tomorrow at JP Morgan or Goldman Sachs with a van full of Ramanujan level geniuses. And we went to the C-suites and said, you can take these geniuses and use them to transform their business. Well, they would say, instead of having your van full of Ramanujan level geniuses, just get me 10 MBAs that have great relationships, understand the context of what we do, have been trained in finance, know how to value a technology company or a bank. We can do a lot with that. I think the same will be true of the models. At some point, the models get smart enough for everything outside of math research or protein folding. But for most knowledge work, they're smart enough. And it becomes about everything you put around the model to make them actually useful.
And it brings up a great point about the value of domain-specific experts. Do you think we've kind of jumped the shark in terms of thinking like AI is going to take away all like the jobs that are ultra specific and have this knowledge in this context? Because to me, it actually feels like those people are more important than ever.
Inside Rogo, we've created an entirely new job description for bankers that have spent a couple years at a large firm and are thinking about what they might do next. Historically, that's been, you work in a finance organization, go to private equity, go to hedge funds or similar. Now we've created a new path, which is you become a forward deployed banker or a forward deployed investor. It's the fastest growing job category within Rogo. I mean, at the rate we're going, we're going to have thousands of them, CJ, in a few years. The notion that that's as institutionalized a career track for a finance professional as any of the other paths I referenced is a remarkable thing to reflect on. And that's because that domain expertise is invaluable. It's invaluable to driving for, in a client-specific, client-facing way, transformation. And so we have, for example, bankers from many of the firms we serve that go from, helping make decks and models and so forth 3 or 4 a.m. in the morning, and then turning around and being an indispensable part of training the associates and partners and even C-suites of these firms on how to actually use AI and how to use it to transform their work. So, it's a very rewarding career trajectory for them, but they also feed pretty much every function that we have, from product to sales to corporate development and finance, strategy, comms, because they have domain depth. And so they can be, coming back to your earlier question about, my own role, they can be great operators, but they can also be great evangelists. I expect a version of that to be happening in just about every area of applied AI and frankly growing over time.
It sounds like half your company does come from an industry background rather than traditional AI engineering paths. What do you think they understand that pure technologists may miss?
I love to think in terms of movie metaphors. And one of my favorite metaphors comes from Interstellar. There's a bit at the end with Matthew McConaughey, and he's working with entities that can, time travel and, reach across millions of light years across space. They don't know what to do with that immense power. And they work with Matthew McConaughey's character because he has a relationship, he has, an empathy for the person they're trying to contact and can, take their immense power and sort of channel it to something that actually drives change, that actually delivers a message. And I think there's an analog in that with AI, which is part of both the promise, but the peril of these AI tools, especially as the models continue to get smarter, is they can do just about anything. Software tools could do a very specific set of things and you could learn that. The challenge and opportunity with AI is because they can do everything, you need to be guided in how to actually use them to be useful to you. And if you're a banker and you're thinking about, hey, how can I use these AI tools to be a thought partner to me or to deliver a SIM or a draft S1 or what have you to a client more quickly or change the way we pursue a transaction, you need someone to direct you. Part of what they see that a kind of, technologist, even a technologist deeply steeped with AI can't see is how to actually deliver that technology in a way that, transforms the life of, a banker or investor or a finance executive using our technology because they've lived it, because they understand, this is actually the wedge use case that opens up that habit loop. This is actually what addresses the myriad frictions that a senior banker or a junior banker or a sell-side research analyst encounters in their work that someone from the outside wouldn't even really appreciate. I mean, I'll give you a little example. Every junior banker, for example, has a set of models that are linked up to an S&P or a FactSet or another financial data provider. Those models are, almost inextricable from the formulas that tie to those underlying data sources. If you want to have an AI agent come in and work with those models on behalf of the bankers, that agent needs to know how to navigate those formulas and edit FactSet formulas, edit S&P formulas natively. The off-the-shelf tools can't do that. A technologist wouldn't even realize that was in the workflow. Our bankers get it, and then can be the bridge between the users and the AI in making that kind of model automation, model acceleration happen.
Sometimes I do wonder though, even though AI doesn't know what it doesn't know, sometimes that's cool because like there's this weekly process I do to update all the valuation multiples and all these fancy charts that I put in my newsletter. And it takes like 5 manual steps that I have to do in this process. With AI, I ended up just like skipping 3 of them and just making them as images rather than PowerPoint. So there's something to be said about both sides of it, of teaching AI how it's been done and like the stuff it won't know that are like earned secrets from the process that you learn. But also like, is there a way to expedite this by cutting 7 things out of the process because we couldn't do that before?
Yeah, I'm so glad you said that because, that's another bit where the domain depth and empathy really matters. AI companies are focused on automating artifacts. An artifact could be in the financial industry, a model or a deck, taking that and having an AI agent replicate that. But one thing you realize when you're in these industries, when you've been a banker, you've been an investor, is that particular form, that artifact, exists because of a specific set of constraints. With AI, those constraints are relaxed or gone. And so, for example, what a lot of our forward deployed bankers are doing with clients is, hey, you can make PowerPoint decks, great. But actually with agents, you can now set up interactive dashboards for your clients. They're not looking at a static PDF, for example. They're looking at, in evaluating a transaction, something that they can query in real time and toggle and play with for different scenarios so that you can get to a much richer set of analyses for, the way a company might be valued, for example. The research analysts on our platform and the firms that we work with, instead of just shipping PDFs to their clients, the traders, the hedge fund managers, et cetera, they can do that. They can leverage the agents to build that. They're actually making agents of themselves available to the traders so that those folks can leverage the expertise of this person in real time. They're still going to want to have their interactions with the human, with all the judgment and the access, but that they can have their John Smith, Jane Doe research analyst agent review their work, and they can query that person in real time and ask questions at 3 a.m. when the sell side analyst might not be available. And those sorts of, in some ways, completely new frontiers for how financial information is exchanged, how decisions are made. I mean, that's the exciting part, but that's where it's easy to miss if you're sitting on the outside and you're just trying to replicate the workflow or the artifact that exists.
And both things can be true, right? Like you don't get to jump to that point of skipping those steps and having a new paradigm of how to get to that output if you don't show AI the context of why you were at least doing that. But I do think it's incumbent upon us as knowledge workers to be willing to accept that, like, dude, you may not even need that model thing anymore. Like, yes, it was important to upload for the context, but like you can get to that output. You just got to think about it differently.
And so much of the technology investment in some ways in the agentic layer is going to habits of work.
That's the word I was looking for. That's exactly what it is. It's just ingrained in you. You do it that way.
Take PowerPoint slides.
They're not that great at moving logos around.
In a couple of years, when agents are doing most of that just basic exchange, the concept of needing to have a printed PowerPoint slide will feel as antiquated as taking a horse-drawn carriage to get to where you need to go. We just need to your point, lay some of the groundwork now and have this hybrid situation where you have agents doing 80% of the work and then kind of human beings stepping in the last 20. But once you have sort of pure agent to agent or agent-led work, I think we're going to move past that horse-drawn carriage era and go right to the next one.
Rahul, I'm going to take you into what we call our long-ass lightning round. So I ask every successful person who comes on the show, You got to give me one thing you've messed up on the job before. You've got to messed up something in investment banking before.
More times than I care to admit. I think it's been long enough, CJ, that I can say this. When I was a new associate, I had just come in from government. I was self-studying wherever I could find the time on corporate finance concepts. Didn't have any of that in my background. I still vividly remember being in the middle of a deal and having made just a little arithmetic mistake, but one that cascaded and resulted in a fairly different output for how to think about discounted cash flow for a fairly large business. I thought that was the end of my finance career.
Oh, I've had that feeling like this is it. This is how it all ends.
This is how it all ends. I was staring into the mirror. Eventually, I fessed up to my mistake. I managed to avoid getting fired, maybe just out of pure pity. I never made that same mistake again. And we managed to correct that mistake before it ended up in a regulatory filing or a board document. It's partly, by the way, what I think gets me excited about these AI tools, and that I imagine there are myriad such mistakes happening all across Wall Street, some of which get caught and many of which don't. Owning the mistake up front. And frankly, had I gotten to that part sooner rather than fretting about it for a day or two and imagining my demise, ultimately owning the mistake led to an outcome that could be managed and one that I learned from. Resisting the temptation to try to sweep it under the rug or kind of wish it away was an important lesson for me.
Making that mistake, I bet, makes you better at auditing the outputs of AI. There are going to be kids graduating from college this month who won't have the opportunity to make that mistake. Do you worry that they're going to be able to detect what's off about something? They won't have the same spidey sense?
The challenge that all of us are going to have is to figure out how to train new bankers, new investors, or new lawyers or doctors, et cetera, quite differently. I mean, that's obvious. That's table stakes. But that I think what people are underestimating is in this new regime, the training I think will get in some ways so much more powerful for the new grads. So I'll give you an example. Our agent, CJ, was named Felix. In part, that's an homage to a very famous investment banker, Felix Royton, who had his deep sense of civic engagement. Part of the reason that homage exists is because Felix came of age as an investment banker at a time when you didn't have 30 associates in the bullpen wearing matching Patagonia vests under harsh fluorescent lighting and, pulling all-nighters, producing books. Felix probably was pulling all-nighters. It was much more of an apprenticeship. He learned from Andre Mayer, who was a very famous investment banker in his own right, and in many ways invented M&A advisory as a business, or at least was one of the folks that did. Because Felix was, in effect, Andre's protege, his mentee, that's partly what enabled him to be Felix. He spent time with clients, absorbed Andre's thinking, was in the boardroom, got the reps on what clients, executives, boards ultimately want, which is strategic advice. All that to say that as agents elevate and empower the junior bankers and professionals to get out of the moving logos around phase of their careers and get straight to, hey, how do you add value in a boardroom? How do you source a deal? How do you build a relationship? I think we're going to see a generation that in some ways comes up the learning curve more quickly.
Okay, I've never got to ask this one on the podcast to anyone before. How did you end up discussing emerging market capital access with Pope Francis?
I'm glad you asked that. It's a topic near and dear to my heart. I was a senior treasury official, and I was brought in another administration to focus on a set of problems at the intersection of Wall Street and policymaking. A core one is if you're thinking about capital markets access around the world as a force of good, as a force of change, part of what you need to do is create a level playing field so that the structures that allow, big established economies like the US to raise money for healthcare and education and roads and bridges and other, useful social investments, well, that you can adapt those structures for economies that look very different. If you're an emerging market economy, for example, and you have lots of commodity exports, you're going to need bonds that, might be, instead of paying a fixed coupon, that might be tied to the performance of those commodity exports, that have this more equity-like component so that there's less risk those countries are taking on. And that kind of financial market innovation is really important. Well, it just so happens that while he wasn't an investment banker, Pope Francis saw things in a similar light. It was fairly forward thinking on those sets of issues. He and his team, we partnered pretty closely with the Pope and the Vatican in general about thinking about how can collectively we advocate for a series of changes in bond markets in the West and in how investors approach, new bond issuances in the emerging markets so that you can open up capital markets access in the ways I was describing. It was a blast intellectually. It was an honor to meet the Pope and something that, I hope over time, pays lots of dividends for the world.
Amazing story. All right, one more. You got to humor me here. You did work in the Obama White House, fact-checking jobs numbers. That is a big job, no pun intended. What did that teach you about the gap between data and narrative and what's actually going on?
CJ, it's remarkable and little known. Every month when the jobs numbers come out, for a brief window of time, there are a handful of people in the U.S. government, at the White House, at the Bureau of Labor Statistics, who get advanced access to those jobs numbers. And by the way, it's pretty heady, albeit in a nerdy way, when you have that, because you recognize you have arguably the most important economic numbers in markets.
You didn't have Polymarket back then or Kalshi.
We didn't have Polymarket, and I'd like to think that even with Polymarket and Kalshi today, that people are protecting this information, but the temptation wasn't even there. The reason you get early access is your job at the White House when you're on the economic team is to rigorously tear apart that data the way a finance executive might with a P&L or a forecast and analyze that for the president. And the president gets an advanced briefing before the numbers become released to the public. I learned two big lessons from that. One is the provenance of every number is so critical. Every number you hear in the press or see in an SEC filing, there's so much by way of assumptions, methodology, statistical analysis that goes into that. And knowing that is key to being able to interpret that number correctly. So much, for example, what we would do is we would take the headline number and then pull it apart. What were the drivers? How are those drivers different now than a month from now? What are the biases embedded in the number? Seasonality is a very common one. The Bureau of Labor Statistics would make adjustments based on the impact they thought seasonality was having on jobs numbers. And those methodologies are inherently approximations. So partly it's never take any number as gospel, always understand what went into it and recognizing that there are always trade-offs involved. And then second, you can take a pattern of numbers, again, might be in a P&L, might be in an economic forecast, and put into it or around it some models that have very different conclusions of the world. Being really thoughtful about, okay, let's not just assume that this set of numbers tells one story. What if we took the opposite position? Can make a case for a completely opposite story.
You're a steel manning it.
You had to steel man, in part because when you're at the White House, you're steel man and straw man by everyone, the most scrutinized numbers on planet Earth. I found that's a great skill set to bring in my current role, overseeing the finance function at Rogo, but frankly, for any number of business roles.
Last one I got for you. If you could give your younger self advice, knowing what you know today, what would you tell him?
I would say a couple of things. One, be really AGI pilled. But my younger self wouldn't have understood what being AGI pilled meant, what either AGI meant or being pilled meant. So in a way, you have to set that one aside, and it's an unfair one. I think a big one is thinking about careers and one's career as an executive as coming straight out of Econ 101. What Econ 101 tells you is that one's value in markets is a combination of scarcity and utility. You get these toy examples in economics about water is incredibly useful. Fortunately, for those of us in the advanced world, it's usually not scarce. And so it tends to be fairly low cost. And then you look at something like diamonds. Diamonds are more or less useful depending on who you talk to, but there's a lot of scarcity attached to them. And so they tend to be high priced. Well, the same is true in some sense of ourselves as folks that have, skills that we bring to the market. And I think something that I've come to appreciate and that I wish I'd even known earlier, what I've told my younger self is to make sure I'm pulling together skills and capabilities that have that combination of scarcity and usefulness. And that's part of what's exciting about being in the AI world, where information about how to use these tools is scarce. And combining that with an understanding of the regulatory environment, of deal making, et cetera, I hope has made me useful in my role today and with the clients I serve.
You've done an amazing job at stacking your skills to create an N of one type category. So I appreciate all the insights today. You're an amazing storyteller, and thank you so much for coming on.
CJ, it's a privilege to be here. I'm a big fan of your podcast, so excited to finally be on.
Run the Numbers is a mostly media production. Yelling and intro by Fat Joe. Artwork by Meg D'Alessandro. Show is executive produced by Ben Hillman. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog way too much ice cream and has a history of net operating losses. LOL. If you like this podcast, hit subscribe and give us 5 stars. It will take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day. Peace.